Yes, sir. We did wedge, and we talked about the falling wedge and the rising wedge.
Okay, so have you been using the falling wedge and the rising wedge?
Yes, sir.
Okay. So before we move on to this class, let's quickly go through the falling wedge and the rising wedge. So we go through our charts and see if we can get any falling or rising wedge. Falling wedge, rising wedge, falling wedge, rising wedge. Do you have examples there?
Yes, I submitted the assignment.
All right, so let me just show you my wedge here. This is a kind of a very powerful wedge. Very powerful wedge. If you got this right, or if you are fortunate to get this, then you're going to bargain a lot of money in your portfolio. You can see this powerful wedge. You can see how it led to massive reversal. First, let's study this trend. We gapped up on the 1 hour chart. We went all the way up. Let's zoom out a little bit. We already know we were in a bullish market trend. All the way up. All the way up. We went through some medium of consolidation, which we refer to accumulation. We manipulated all the way down. We jumped up, we rallied up. After that, we continued, and suddenly we formed a wedge, and the price broke all the way down. Now let's study this wedge. Now these are the types of wedge you want to trade as a trader. Now just study this wedge. In fact, study this wedge. You can see that. Now study the bottom. 1 right here, 2 right here, 3 right here. We had our minimum 3 touches before price went all the way up to fill in the last touch all the way down. Now let's study the test at the top. 1, 2, 3, 4, and the 5. This is a well-defined wedge. These are the type of wedge you want to trade as a trader in any of the markets you wish to trade. Either it be Forex, crypto, stocks, commodity, index market, whichever of the market you want to trade. These are the type of wedge you want to trade as a trader. Now, we've been talking about chart patterns. We've been showing you how to draw the lines, how to construct the lines. Now, let's talk about how we can set our stop losses, our take profit in this type of chart patterns whenever we see it on our trading chart. So we are going to make references to this pattern right here because I love this pattern. So we have to put the reference of the date all the way down. So this pattern was formed on the 26th of October 2025, and on the 1 hour chart, right, it's a rising wedge. Right now, after we have this rising wedge, price went all the way down. Now, if you were to trade this type of pattern, do you know where you are going to put your stop loss? Do you know where you put your stop loss? Now,
Yes, sir.
Trading this type of pattern is simple. It's straightforward, rather. Now, the first thing you want to do whenever you see price breaking out of this pattern is you want to put your entry here and have your stop loss above. Now, which means if you were to make an entry on this market right here, what would you do? The first thing is you decide your entry zone and you place your stop loss at the edge of the last test of the upper trend line. When I say the last test, this is the last test right here. So your stop loss goes above it slightly with some pips away. This could be 5, 10, but I do advise traders to provide a minimum of 10 pips above based on market run activities. Market could just go up and tap into your into the eye of this pattern and then continue backward down. So you wouldn't want something of such to occur. So you can just do something like this. You measure from the tip of the last edge, you measure 10 pips above, 10 pips above, then you place your stop loss at that 10 pips above. Then from your entry all the way down, can you recall me the measurement objective of this pattern? Do you know how we construct it? Do you remember that? Okay, now based on what I taught you in the last class, I said for you to measure the measurement objective, we have to look out for the edges which falls inside this wedge, for the two edges rather. Now the two edges which fell into this pattern is starting from right here and right here. So this pattern went all the way here and filled all the way down. Unlike what we had right here, we were unable to connect trend lines here. We connected trend lines right here at the bottom, but we were unable to connect any trend lines connection at this edges right here. So we can't choose this level and this level. It's inappropriate. So the best thing you would want to do as a trader is you want to construct from this high all the way down. And do you know why we want to construct from the high to the down?
Yes, sir.
We want to do that because this pattern is showing a sell. Since it's showing a sell, we are anticipating price should go down. Now for price to go down, we have to measure from this high all the way down to the last touch, which is 146 or 147 or 150 pips. Let's just approximate to be 150 pips. So what you want to do as a trader is once you measure 150 pips from the edges side, the upper trend line and the lower trend line, then you want to replicate this distance movement from your point of breakout, not from your point of entry. From the last test before the breakout, then you replicate it all the way down. Remember what I told you in last class? I said the MOBK is for the TP1. So you can see right here now, our TP1 right here says 1.8. 1.8. Now, if you are a good risk manager, then what you want to do is, okay, how can I look out for a retracement and maybe 2.0 so I can have the minimum 2:1 ratio. You might end up losing this trade. Why? Because if you had waited for a retracement, you could have missed this trade because market didn't retrace. And then again, there wasn't massive volume breakouts right here. So if I were you, or if I were to be a trader in this market trying to trade this pattern, I wouldn't have shorted this market. I wouldn't have sold. And here is the reason why I wouldn't have sold this market. Number one is based on the fact that I couldn't see a massive sell-off at this breakout. It was just a kind of a weak low volume. And when it comes to trading chart patterns, we need to understand massive volume is essential. Without a massive volume, the trade movement is under low probability. So this is why I wouldn't want to short in this type of market. Well, it is what it is. The market can decide whichever way it wants to go. But it's better to always look out for high probability setup, high factors signaling a massive movement or aggressive movement in the market. Now, based on what I can see right here, I would have missed up on this trade because I couldn't see a massive sell-off. Only if I had used another trading concept at above right here, which is based on liquidity concept. Based on price taking out the double tops right here and then sweeping it all the way down, I could have shorted right here and they'll use this zone right here as a confidence to lift my trade all the way down. Well, let's just go back to the concept we have in this class today, which is about wedge. So if you were to use a wedge right here, your stop loss should have stayed above, and then based on the risk management principles we have taught you in your trading career at ChartsEmpire Trading Academy, we told you you have to look out for a minimum of 2 risk to reward ratio setup. So this trade is a good trade, but the risk didn't give us a better entry. Well, by the way, based on the trade setup which occurred right here, you could have placed entry right here, place your stop loss above, and then use the MOBJ, the measurement objective, to move the price all the way down. You can mute your mic. So that is it. So now, based on what we had right here, this is our TP1, and then our TP1 aligns to a strong demand zone. You can see right here we got a demand. You've been taught about support and resistance. When we talk about demand, we are also referring to support and resistance on the trading chart. Now, demand represents support zones. Now, our TP1 right here aligns to a demand or a support zone which acted as a valid one, although it created an inducement like a trap. An inducement is a trap whereby people believe, oh, this is a support zone, now it's time for us to buy. But price did what? Price broke that level and then led into a liquidity, sell side, buy side, liquidity. You are here to get to that zone. So market went all the way down. In short, in summary, buyers were deceived right here to execute a buy, and the market went all the way down. So now you can see that. So with a wedge, we were able to know when the market came to a stop at this bullish swing. Now that is how you set your stop loss on the wedge, and then you write it TP1, and then after your TP1, some trader will look out for the next support level, which is where this is a massive swing level right here, which would be our support. You can see price go to this level before it reverses all the way up. Let's check this next TP. That is 3.7. That is TP2. So this is how you use the wedge chart pattern, a rising wedge chart pattern rather, to sell, to continue a downtrend market structure or to reverse an uptrend market structure. I love this setup right here. Now let's move all the way down and see if we could see possible another rising wedge or falling wedge. Just what I told you, I said the best way to find out this pattern is to zoom out totally on your price chart. Without zooming out, you can see them. They tend to hide on the charts. So we move on to other time frame or zones in the market. We move on, and can we find another rising or falling wedge? This time around, I think we need to get a falling wedge. Falling wedge. All right. I think I got one right here. Let's find it out if we can draw it. All right. From this structure, from this level, we construct a trend line above, all the way like this, and at the bottom we have our wedge like this. This is not a wedge. I told you the principles for connecting a wedge. This is not a wedge. Now we move on. It's not a wedge. We move on if we can see something else. All right, we have gone over the limit of this subscription. Let's go to Euro Yen and see if we can find a falling wedge. All right, now we look out for falling wedge. You can go through your examples you constructed, the date, time, the chart. Let me see. Tell me the chart, the time frame you constructed, so we can use that. You can go through your example and tell me the chart, the time frame you use. Tell me so we can use it in our class. Let's check this out. Okay, this is a good example right here. Yes, this is another good example. You can see I love this as well. Now this is a falling wedge. In this falling wedge right here, this acted as a continuation of an uptrend market structure. You can see how markets continue to rally. We were in a bullish market structure. There was a short pause in the market. You can see that market rallied all the way down, and we constructed our wedge. Market broke the wedge with a bullish engulfing candlestick, and what happened? That was a bullish Mariposa candlestick. If you combine them with the red, that's a bullish engulfing, and the price went massively upward. If you were to trade this currency pair right here, you first thing you want to look out how defined this falling wedge formed. We have 1 and 2 and 3 and 4. We have more than the minimum. The minimum test is 3 at the bottom, 3 at the top. We have 1 and then 2 and then 3 and then 4, which means this pattern is qualified as a falling wedge. Now, since we've seen we have a falling wedge right here, the next thing is to see the direction of the momentum, which is direction of the trend. We zoom out on this price chart. We can see the market is moving in a bullish market trend. Now, the falling wedge right here signified a pause, a short pause in the market. We zoom in again. Price broke out with a bullish engulfing candlestick. This indicated the continuation of the existing bullish rally. Now, you could have placed your buy in this type of market right here. This is the type of volume I stated on the rising wedge. Remember, on the rising wedge, I told you I would have missed that trade. Why? Because I couldn't see a massive, strong bullish strong volume breakout. In the case of a rising wedge, we need a strong bearish volume breakout. But we couldn't see that on the Forex example I showed you. But in the case of this falling wedge right here, we had a what? A strong bullish breakout. These are the types of breakout I want to see. You can see a bullish parabolic candlestick, which indicated the aggressiveness of the buy setup. You combine it with this red candlestick right here, that is a bullish engulfing candlestick. Now, I will place my stop loss at the last test of the lower band trend line, which rise here. Don't forget the 10 additional risk pips all the way down, 10 pips. So I put my stop loss all the way right here. Why are we doing this? We are doing this to be prepared for possible market run. Market run means, okay, market comes all the way down, swipe all the way down, and then continue upward. So it does happen. If that should happen, then that is what we call liquidity, because you might have not gotten right there. You haven't gotten right there. Based on what we have right here, price could still create some internal liquidity right there to go up. To take out stop buyers here, we place their stop loss at this zone, onto their stop loss, and then move up. So should in case something like that occurs, that is why we have additional 10 pips to provide enough shock absorber for our trade. Now, we had our stop loss all the way down, and then the next TP zones. How can we know that? Now, what we have to do is to look out for where our touches of the upper and lower band. Now, we have the first touch right here and the second touch right here. This is the final. Of course, we had the touch right here, but we couldn't fill up this section to trend line. So we are not going to use that zone. We're going to use 1 and then 2 right here. So which means market is testing from this level all the way down. So based on what we have right here, from this point here, from this point, if we should measure from this low all the way down right here, that is almost 100 pips minus 100 pips right here. Of course, if we were to measure from right here to this level, it's not possible because the way this market was being, this pattern was being formed. So we have to go against the rule, which says we have to measure up to check the measurement, right? But this case around, because of the way price has been formed, we have to take measurement from the up to the downside, which is against the direction of the momentum. We have to measure up to read the bullish leg, but we can replicate this, which is minus 91, so we turn it to positive 91. So from the point of breakout, not from the close of the breakout bar. From the point is different from the close of the candlestick confirmation. From the point of breakout right here, they will measure 90 pips rather, 90 pips right here. So you can see that. So based on this 90 pips right here, our stop loss goes all the way down. You can see that is 1.2. So our measurement objective is showing us that 1.2. If we were to take this trade right here and we have our stop loss right here, then this 1.2. Yes, I will take this trade, but I won't target this zone as my TP. I would rather target it to be 2 above right there. But what I would do is, whenever price keeps on getting to my measurement objective, which is my 1.2, I will break even. Yes, I'll break even. Now let's see it once again. Let's take for instance, you measure 1.2, which is 90 pips, and let's go and use our measurement tool from here all the way down. This is 92 pips, and from the breakout point, which is 92 pips around this zone. So when the market got right here, from my point of entry, I would have traded some pips all the way up. You can see, if you had traded your profit, you would have survived in this pushback if you didn't trail too much. You don't have to trade too much. You are just preparing for possible pushback or reversal or surprise. Now the market went all the way up. Now let's imagine we are able to target like 2 risk to reward ratio. We could have rolled this trade to this level. If you are targeted times 3, then you could have rolled to this level right here. You can see that. So that is how to use our wedges chart patterns. You can see that is simple, that is easy, that is easy, that is easy. So is that clear? Is that clear? Is that clear?
Yes, sir, it's clear, sir.
All right. Now let's look at for another possible examples in the market before we move on. We look at for another example, another example, another example. Can we see more example in this trend rally? We have to zoom out, and then let's look at for another trade setup. All right. Let's look at for another trade setup. Let's look out for another. Okay, we have a good one. I think we have a good one on GBP USD from this low all the way right here. We fired it all the way up, and we have our trend here. I'll fire it all the way up. Let's zoom in and see. Okay, this high and this high. Yes, so this is another wedge. We have our minimum requirements. We have the 1, 2, 3, in fact 4, which was a sweep. 1, 2, 3. All right, so you can see that. Now this is what I stated. Price didn't break out with strong volume here. You can see no strong volume here. What happened? Price later retested. Now imagine you place your sell here and you put your stop loss around this zone. You can see you will have been out of this trade. You can see. So those who had their stop loss above here. In this type of trade whereby I said add 10 pips. In this type of market whereby you have this massive retracement of bar the way down, you can't add 10 pips. Just have your stop loss above this trend line, these zones. Now that is why in trading you have to be flexible. You don't have to be rigid. That is why you have to also use your sense, and that's why you also need to understand. Because if you don't understand, you think you want to copy and paste. You can't copy and paste in trading. You need understanding. So market close all the way back down. Your stop loss could have been above here, all the way down. So that is it. Hello. Hello, good afternoon. Please let me call back. I'm in a meeting now. So that is it. So is that clear? Is that clear?
Yes, sir, it's clear, sir.
All
Yes,
right.
sir.
So we are done with wedge pattern. This is just a revision class on how to set your stop loss, put your stop loss, right? So if you are trading a wedge or chart patterns, you have to think in terms of long-term goals. Long-term goals. All right. So there is a trade I was monitoring on gold. Actually, I saw this trade and I was waiting for price to just give me like a pushback because of what I saw there. And on the 15-minute chart, you can see how price close above this low. So it's possible you might see a trade opportunity after this class. So price close above this level with a sweep. Now, I don't want to just jump in right here. I want a massive push, retracement, and rejection. So price didn't give that. So we are still waiting for 1 hour. So let's see if this market can give us a FVG. If you are yet to know what FVG is all about, just exercise patience. After this bar is formed, if it formed a bullish bar, if another one goes up and then goes as another bullish candlestick whereby it takes out this high, so we have a FVG right here. So market could push all the way back here and then continue all the way up. So that is what I have on gold. So if you're a trader on gold, you can check that out, because I'm monitoring that right now. I want to see possible buy. So I don't want to jump in right here on the 1 hour charts, and I want to see some level right here. Price comes out back, because if you check this market structure, you are going to see we have low high swings here, and we have our series of low high swings. So jumping in right here without price taking out this low high swings is a very dangerous game. So I want price to go this way, take out this high, come back here, then mark it up. So that is good. And then if you can see something like that, have you done it and shoulder?
Yes, sir.
So we're going to have something like a right shoulder, inverted head, something like maybe another shoulder right here. Then we continue the way up. So that is possible. Now, what we would want to do today is currency correlation. So based on currency, okay, before we move on to currency correlation, as a trader, I will teach you, I will advise you to go and master bottoms and tops, because those are most of the liquidity zones in the market. Market goes like this, goes like this. Go and study this pattern. Market goes like this, goes like this. Go and study this pattern. Market goes like this, goes like this, then goes like this. Go and study this pattern. Market goes like this, goes like this, goes like this. Go and study this pattern. And then again, market goes like this, goes like this, goes like this. Go and monitor this pattern. And then market goes like this, goes like this, goes like this. Go and monitor this pattern. Right? So I gave you 6 patterns. Those are powerful patterns. If you want to trade, these are what most time market do: to reverse, to continue, to take the money out from inexperienced traders in the market. You can see we have top 1 here, we have another top 2 here. Market went out and take out these 2 top, and then it went all the way down. You can see that. So that is it. We have our bottom 1 here, our bottom 2 here. Market didn't take out this bottom. The reason why I'm very careful to buy here. So I want market to come back right here, fill this zone, go up. So anyways, if you opted in for the advanced market training, you are going to learn about all those 6 patterns I drew earlier. You are going to go through that if you opt in for the advanced training section. So which is for another 4 months. So if you opt in for advanced training, you will learn more about all those advanced market movements. So now let's go to currency correlation. So the currency correlation we have right here is all about how markets are related, how currencies are related. Now mute your mic. Now, if we are talking about currency correlation, this is showing us similarity between currencies. We know in the Forex market, if you want to buy or sell currencies, you have to pair them together. You pair the currency of one nation, you pair with the currency of another nation, which means if you are buying one indirectly, you are selling the other. Yeah. So Sometimes there may be similarity or disagreement between currency pairs, but if you are buying or selling currencies of the same similarities, then you may have difficulty. Now, let's look on this table. Now, whenever we see a currency pairs which has from 75% above, that means they are similar. 75% in the academic standards or assessment or grading, rather, it means A. If you have 75%, that means you fall into the category of A plus or A student. Right now, any currency pairs which has 75% net positive, it means they are almost correlated. And if they have 100%, it means they are the same. Which means if you are buying a currency pairs which are 70% positive to another currency pairs, it means you are trading the same thing. If you are buying and you are buying another currency pairs of the same correlation, you are doubling up your risk. Now, in this section, we discuss what doubling risk is all about. Now, let's get it started. Now, the first thing we want to do on this Forex correlation is let's check AUD card. This is Australian dollar paired against the Canadian dollar. Now, look at Australian dollar paired against Canadian dollar. It means if you cross this currency here and you merge it with the one at this vertical. Now, we know what vertical line is all about. Let's go to our chart right here. Now, this is what we call vertical line. If you construct this like this is a vertical line. If you draw this like this is horizontal line. So you have to get that right. Now, I will draw that again. This what? Let me make it to be straight. This what? A vertical line. And this what? A horizontal line. Now, if you match a horizontal line plus vertical line, you have a cross. That is why we call it correlation. So let's see what would happen when we cross different currency pairs together. So it means before we can cross currency pairs together, one has to be horizontal, one has to be vertical. So which means if you have like GBP paired against USD right here on this line, and you have Euro paired against USD right here, what would happen when two of them come in contact at this center? That is what we want to study under currency correlation. Wow, gold is pushing up. I saw it, but making a buy right here based on this market structure is not the best thing to do. Unlike what we had right here, this low we're taking out. So this is a good buy. But what we had right here, lows were not taken out. So let's see if lows can come out and go up again. So I'm monitoring gold. And I don't know if you attended the live stream today. I did a live stream on GBP. Whoa. GBP USD. Whoa. This is a massive sell. This is a sweep from the top. Let's study this out. Let's go to the day chart. All right. We have a peak here. Let's check last week. Last week range. Okay, last week range, we got it right here. Let's study last month. Okay, we actually had a range here. Let's go back to the weekly and the daily, and then the 4 hour, and then the 1 hour. Okay, now I see that market is trying to do something. Either move to this zone right here. We have a lot of imbalances market would want to fill. Imbalances are so many along the way right there. So there's a lot of magnets attracting this price here. So what we want to do right here is study the momentum of direction. Sorry, I'm trying to see if we can get a trade together live today. So we have higher swings, higher low, all the way up. This is a trend line liquidity right here, a nice powerful zone buy. Now, based on what I'm seeing right here, I think there's a news. Let's check if there's a news in the market making price to be volatile. Now we are on Tuesday. We have German. This is 240. Let's refresh. Okay. Let's see. The market is kind of volatile. 16th December Tuesday. This is 215. This is 230. Oh, there is core retail sales, average hourly earnings, non-farm employment change, retail sales, unemployment rate. Wow, USD is kind of a weak on retail sales and unemployment rate, and the non-farm payroll is positive, and the USD core retail is positive. So these are missed. We see our flash manufacturing PMI and the flash services coming up around 345. Okay, let's go back to the chart and see technicals. Now, for this 1 hour to be confirmed for itself, 1 hour.
That when is when
I'm with you. Now, for this trade to be confirmed for itself, 1 hour have to sweep down the last.
Yes, when the color showed the red, that means that. Hello, can you hear me, sir?
I'm with you. Go on. Ask your question. This risk is kind of not favorable. 1.7. No, we won't take this trade. We wait for it to come on. Ask your question. We wait for this trade to come all the way down here.
Yes, can you hear me, sir?
I'm with you. Ask your question.
I want to know if when you are the Forex calendar, like,
okay,
when the show is red, that means that it's not good to trade that day or what?
No. That doesn't mean it's not good to trade. It means that currency in reference is weak. The news on that currency is negative. It's not favoring. When red comes out, it means it's not favoring. It's not encouraging for the economy of that nation. USD unemployment rate. It means unemployment rate. The numbers of people who were unemployed increased, which is not good for the economy. You can see that. So if you don't know the meaning of unemployment rate, you can open this box and read more. Percentage of the total workforce that is unemployed. You can see people are unemployed. Retail sales, if you don't know the meaning, this will change in the total values of sales at the retail level. So if the sales of goods is getting low, it means people are not buying. So it means the economy will not be going well. If people are not buying, how will companies in the companies organization make money, make profits? And if they don't make money, they don't make profit, they won't employ. Those who are employed, they will tell them to go off because they won't be able to pay their salary. So this is not good for USD. Whereby the non-farm employment, if you don't know the meaning, you go to it, you read it, change the number of employed people during the previous month. So that is non-farm employed. So it means right there. So for now, we haven't gotten to the stage whereby you trade news. So if you trade red, that doesn't mean you should not trade that day. If it comes green, that doesn't mean you should not trade that day. It's telling you what is going on in the economy of that currency. Maybe it's good or bad, how it will affect the currency. So now here we are having missed. So the market is going to be volatile, moving up and down. So you can see that. So let's see how we can relate technical. Based on the 4-hour chart, the market is strongly bullish. So the next point of interest on this market right here, if even a sell would come out, should be around this zone. So liquidity is yet to be taken out on that place. So I'm not going to sell right here. I'm not selling. I'm still looking out for buy. So let the market come all the way down, because we have a strong demand. A strong demand at the zone. Can see that. Can see how that level I respected price, and price went all the way up. So this is strong demand. So price retested, and then check it on the 15-minute chart. You can see on the 15-minute chart how this price trends. So this is just news now. So I'm not taking this news. This is just the news. So wait to see how it reacts at these lower levels. Right now, let's get back to currency correlation. Now, I've told you what vertical and horizontal is all about. AUD card and AUD card, when you compare them together, they are positive. That is 100%. That means they are the same thing. Now compare AUD card to AUD JPY. They are 51.4. They are not so much related. They are averagely related. There is average. Now, AUD Canada to AUD New Zealand, they are 11.1. That means they are differ. They are differ. They are differ. Now, AUD CAD to Euro AUD, they are minus 79. That means if you are buying AUD CAD and at the same time you are trading this Euro AUD, Euro is the base, while AUD CAD is the base here. So if you are buying AUD and you are selling Euro, that means indirectly you are buying this AUD. Yes. If you are buying AUD, that means you believe AUD is stronger than CAD. Now, if you are now buying Euro, you believe Euro is stronger than AUD. That might be possible, but they are not correlated. They are not correlated. Now, let's check AUD CAD and New Zealand CAD. AUD CAD and New Zealand CAD. AUD CAD. AUD CAD. Let's check New Zealand. This is AUD. AUD is on the first section, the vertical. So let's combine it with New Zealand CAD. That is 41.7. You can see almost average. Almost average. Now let's check AUD JPY and New Zealand JPY. New Zealand JPY. That is, can see that is AUD JPY and New Zealand JPY. Okay, New Zealand JPY, you can see that this is the vertical, and AUD JPY, you can see they are 91. That means this currency pair they are so related. They are almost the same thing. So if you are buying New Zealand JPY and you are selling AUD JPY, you are putting yourself into trouble. You can see they are almost 91%. That means they are so correlated. Now let's check this 84.0. New Zealand JPY and Euro JPY, they are correlated. Why are they correlated? Because they have the same quotes. See, JPY, Euro JPY, the quote is JPY, you can see. Now let's check GBP USD and Euro USD. You can see they are correlated because USD is the quote. They are sharing the same quote. And GBP and Euro, they are almost related as well. So let's check USD CAD. GBP USD and the USD CAD, can see the USD is the quote and the USD is the base here. So they are opposites. So that is minus. So which means if you are buying GBP, you believe USD is weak. So if you are now selling USD against Canada, that is still reasonable. So you need to understand this. So which means whenever you want to trade, you must always make sure that your base currency pairs, when you are selling a base currency, you shouldn't be buying the same base currency on another currency. If you are doing that, you are trading against yourself. Like AUD is your base, Canada is your quote. If you are buying AUD, you shouldn't be selling AUD on any base. For example, you are buying AUD Canada and you are now selling AUD Swiss. You can see you are not trading the right way because see, 69.6%. AUD and Swiss, they are almost related. Why? Because they share the same base. Now check this one. AUD Swiss, AUD is base and AUD is quote here. You can see they are opposite related. AUD is at the quote, while AUD Swiss is at the base. So you can see that. So it means whenever you want to trade as a trader, the first thing you want to see is that you want to see that your base, we've taught you base and quote. Now it means that your base, if your base is USD and you are buying USD, then don't try to sell anything USD base anywhere. If you do that, that is wrong. That is wrong. That is wrong. Don't do that. If you do that, you lose money. The only thing you can do is, if you are buying USD, then make sure if you want to sell any currency, then the currency should be something like, or maybe GBP then /USD. So if you are selling GBP and you have USD card and you are buying USD, you believe USD is strong. So because you believe USD is strong, that's why you are selling GBP USD. Now let's check out the correlation between GBP USD and USD card. You will see they will be different. GBP USD. Okay, USD is USD card. Now let's relate it to GBP USD. USD card with GBP USD. Let's find GBP USD on the scale. GBP USD. Now GBP USD, let's find it on USD card. You can see they are minus 71, just like what I said. They are not related, they are different. So whenever you are trading and you are buying a base currency pair USD, then you shouldn't be selling the same USD base. If you are selling USD, which is the base, you shouldn't at the same time be buying that USD again. So now check the currency pairs I have on my right hand side of my screen. You can see I have GBP USD, Euro USD. So if I'm buying GBP USD, it shouldn't be selling Euro USD because they are correlated. So which means wherever GBP is going, Euro will follow. AUD USD, New Zealand USD. You can see they have USD as their code. So wherever all these bases are going, they tend to follow each other because they are all trading against the same codes. Now you can see the way GBP USD is falling down on USD. GBP is falling down because people believe USD is strong. That's why you can see that retracement. Now let's check the retracement on Euro USD. You will see Euro USD would have retraced. You will see it would have retraced. What can you see? It has retraced. Now imagine someone who is now buying GBP USD and selling Euro USD. As it's making loss on GBP USD, Euro USD is giving profit because they are not related. Because as you are making loss on GBP USD, Euro is giving you profit. So which means when you make profits, GBP USD will collect it. When Euro give you profit, GBP USD will be collecting. That means you don't have anything to show at the end of the day. So you have to trade in the same direction for this type of currency because they are correlated. They are almost 75% close to correlation value. Right? Now, if you now check AUD USD would have retraced because USD is their code. You can see AUD you can see what is happening on AUD USD. Now check New Zealand USD. You can see that as well. You can see. Now check USD Canada. USD Canada would have gone up. USD Canada will now be buying. Check. You can see it's now retracing. You can see it has gotten to this low. You can see now it's now going up. So you can see that. So you need to understand those stuff under trading. If you don't understand those stuff, it will be difficult for you as a trader to trade and make money. So those who want to buy now, they already marked this support and they are targeting to see, okay, can we see price coming here and then taking out liquidity out? You can see that. So USD Yen too will be going up now. You can see USD Yen has gone up. You can see that it has gone up. USD Swiss too would have gone up. You can see USD Swiss have gone up too. So because they are correlated, that's why you can see gold too will be coming down. It will come down a little bit, but not as fast as other. Gold is different, sign kind of differently correlated. You can see it went down a little bit, but it's starting to go up again. So based on what we have on gold, we are still waiting to let this forward to be done, and they will target this level for a retest. So, are you still in the class?
Yes, sir.
All right. So that is what I have for you. Don't worry, we are still going to continue our class in correlation in the next class. It's just an introductory, so it may sound so strange to you. Don't worry.
Yes.
we continue in the next class, right? But just make sure to watch this video to have an idea that whenever I have a setup like GBPUSD, let's go back to this. Whenever I have a setup like GBPUSD and I am buying it, then if I see any sell on Euro USD, I should not sell Euro. Why? If you are buying GBP, you believe USD is weak. Now, if you believe USD is weak, then any currency paired against USD, you should be buying them. If you can't see buy, leave them. But if you see that sell, you have to be very careful. Why? Because if you open a buy position on GBP USD and you are now selling USD on another currency pairs, then you are trading against your... if you are buying GBP USD and you are now buying USD like USD card, this is a wrong trade. You are buying GBP USD at the same time you are buying USD Canada. You are doing the wrong thing. Why? Because if you are buying GBP USD, you believe USD is weak. So instead, you should be doing what? Sell on USD. If you are buying GBP USD and at the same time you are buying USD, that means you don't know what you are doing. Because if you are buying GBP USD, you believe USD is weak. That is why you are buying GBP USD. So why are you now buying USD against Canada? So don't worry. As we keep on going on, you keep on understanding more on this. So gold is going up. Let's see how far it can go. All right. Thank you. I'll see you in the next one. Peace.
All right, sir. All right. Thank you, sir.
You're welcome.
Yes, sir.